Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold yourself harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone, unlike Google, Facebook, Amazon, and every freaking other person on the planet. That is really insane what's going on there. All right, so what's happening, folks? First, we'll see if we have any opening questions. I hope everybody's very well hedged for this exciting market. We have some nice little dips going on here, and nothing like a good bounce to play off. Oh, CMG, who the hell's looking at CMG? Well, we shorted them, so that's good, actually. YM is the Dow. Oh, so good time to discuss. This is what a weak bounce looks like. When you see these bounces, the reason we put up these things. All right, let's do that. That's really, really important. When you're in a downturn, and this is so important, you could have saved yourself a lot of money in 2008. When you see a bottom forming or a pattern forming, it doesn't mean crap unless you beat those bounce lines. Because all you're really doing is consolidating for the breakdown, not necessarily coming back up just because it stops going down. And so what did we say in the chat room this morning as we were going down? I said, where did I say it? Find PhilStockWorld. There we go. Step 1. Step 2, find the post. Step 3, find the comment. My life is so complicated. All right, let's see. Dun, 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 dun. What an amazing variety of stuff we talk about. Oh, here we go. Okay, great. Oh, I love these charts because this actually shows you what's going on. I think they're well, let's see if they're refreshed. All right, I think they're pretty much up to date. Where is it down right now? Oh no, it's getting much worse. Okay, anyway. Wow, down 430. We're like making a new leg down. Anyway, point being, so here we are at 10:30 as we're heading down. I wish this was a 5-minute chart, but it's not. But let's take a look at a 5-minute chart. There, and we'll look at a 5-minute chart. So at 10:30, we were about here. Okay, not much further, about where we are now, frankly. And what did I say? So I said 2650, remember, is the 25% line. That goes back to the morning post where we were discussing, well, hang on. See, I get frustrated because I'm used to having like a bunch of screens. So like if I go over to the other side of my desk, there's 6 screens, and it's annoying to have to just do everything on one screen. But that's okay. All right, we'll get through this. All right, so going by the big chart here, what I was saying is, excuse me, what I was saying is 2650, see 26250? I hope that's what I said. So 26250 is the real line that we care about for the bounce because that's the 25% line. So once we go below it, That's the line you care about, not the intraday or short-term lines or anything like that. So so I said 26,250 is the 25% line. That's now, we started the day here above it, and now we're plowed right below it, like by a pretty wide margin. But at the time, I was saying, remember 26,250, because we were about, I don't know, we were about here, about 100 points down, or 100 points below that line. Is the 25% line on YM. That's when we shorted, because we shorted 26,250 in the morning. That's more important than the bounce lines off the fall from 25 to 26,150. So we were at 26,150 while I was saying that. That's right here. And I said, so call them. Now, because you fall from 500 to 150, all right, that's a 350 point drop. And so your bounces, the retraces, and you go from consolidation level. So you find a consolidation line. So from that line to, well, wherever you are at the time, if you want to find out if it's bouncing, we were starting to maybe consolidate here. And we did a little bit, we consolidated a little bit over here. I said from consolidation to what you think is consolidation, the way you know if you're really recovering is you want to see at least a weak bounce. A weak bounce is a 20% retrace of the drop from the period you're looking at. And the more significant the consolidation is, the more you can count on it. So we had for an intraday perspective, from an hourly chart, we had a good consolidation for 2 days at 26,500. So that made that a very good line. So we fell from 26.5 to, we don't know where it's going to stop. But if you think it's stopping here, the way you check it is to make sure you have at least a weak bounce. And a weak bounce would be 20% of that drop. So 70 points up would be 26,225. Now we go back to this, the 5-minute chart of the Dow, and we see that was at 10:30. We didn't come anywhere near 26,225. So now you know that from that point, then you should not be playing bullish. Here's 26,225. And in fact, frankly, I should have been more on the ball because it failed at, I need a better close-up than that. This is 10, this is 11. So this is 10:30 when we were talking about it. When did I say that? As I was writing it, we were here. I apologize. We had touched here. We did bounce to 26,225, almost on the nose, but we failed at the weak bounce line. But that's what the 5% rule is for. It teaches us these things so we know what to look for. And failing a weak bounce is bearish, and then breaking below the lines, which is something I mentioned after that. When you break below your bearish lines, then you can short again and short for the next leg. My brain is fuzzy. Okay. On the so same concept on the S&P, we had a weak bounce, and now all of them failed, obviously. So blah blah blah. And the DAX failed. Its line, it's my headline for the day. As I said, watch out for the DAX. If it fails, we're going to get sucked down the hole. Euro stocks, blah blah blah. So, where did I say it? I know I was explaining what to do. Oh, I'm sorry. I said it before I did the charts. I did the charts to illustrate what I said because I said it before earlier because I was wanting to reshort. So in other words, look, we had a nice $500 per contract winner on the Dow. So I said, let's take the money here. But then you start watching these lines, 26,150, 72.25, 1,600, and 28.50. And if all those fail, which of course they did, then we go and reshort again. That's when you go back in and short again. So when you see all the lines failing, there's 26,150 failed, 28.50 failed on the nose. Yeah, and let me tell you something. When you're able to go, you can call these numbers to the penny of where they're going to be before they're there. You have a good rule. Your rule is pretty good to use. And I mean, it's really okay. 72.25. I mean, this is funny because I was saying this at 10:30. 72.25. Oh, I only said 72.25. Wait. I'm wrong on that one. What? Did I do the math right? I might have done the math wrong. 72.25. Why would I have said that? Here's the same place, 72. Oh, I guess I just hadn't failed yet. I was looking for that to be the fail line. And 1600. See, I'm pretty strict with myself. I had to go by the rule, not by what I think. And we were looking for 1600 to fail. So I said, when those things start failing, you short the laggard. And in this case, they're not really failing. I mean, you know, a little bit of failure here, but that was right on the button, 2850. 1600 is right where we're holding those. 72.25, right where we're holding. And so basically, the Dow is kind of laggy to the downside, but not so bettable. I mean, right now, this is a nice drop. 2.5% a day is a lot for an index to move. And again, part of the 5% rule. These significant moves are going to be 5%, 2.5%, 1.25%, and 0.625%. So it's half and half and half, and going up from 5 is 2.5, 5, 10, and 20 are the next significant lines. So that's how you want to break up your moves in the indexes. So of course, and the closer, the 5% is very significant, but it's so significant that it's highly unlikely an index will move that in one day. The higher you go, the more unlikely to move it. So 0.625%, that's perfectly normal. 1.25% doesn't happen to an index very often, that kind of move, up or down. And 2.5% is almost unheard of. So when you get a 2.5% move in an index in a day, which is really the low on the NASDAQ here, at pretty much that 72.25 area, you can pretty much be sure it's very, very unlikely to finish below that for the day. And I'm not saying go long on the NASDAQ, but if you were going to go long, it's a good place to go long. I mean, this market is ugly, and the storm is smashing Florida and all kinds of, it's just not a good day to be playing really at all. To watch and see what happens. So anyway, so that's how we were watching things. And you can always calculate, look how ugly this is. Holy cow, they see that 1600 is going, all these lines are breaking. And that means really short laggard, but the Dow made a huge move down, so it's not really the lagger of the day. Just going by the numbers, the Russell is actually lagging and the move below 16. So there you go. So if I had to choose, and I don't have to choose, but let's choose because I'm doing a webinar and I should do something. I feel like you get your money's worth. So, that update is a little late. So I was going to say, so if you're going to short, though, I would short below this line with very tight stops because it's the safest place to short. Now, as you can see, things are getting a little bit bouncy. Oil now is interesting. What I was going to say at the beginning of the webinar, though, was RB, because gasoline at 203, considering that there's a chance that refineries are going to get knocked out and so on and so forth, I think that's a pretty good play. It's only the 10th. There's not a lot of contract pressure on the rollovers, and we have the inventory tomorrow. Might be good, might be bad, but I think they can manage a rally in the inventory. So I like this. I really would have liked 202 though. I'm kind of disappointed I didn't catch that. Similarly, the Dow, if we're going to play long, we could play off 26,000 because that's a good significant line to play below. But we missed it, and we missed this, and so I'm not happy I missed all these. So I'm not really looking to chase them, unfortunately. Sorry. But that's the point. When you get to these super significant lines, and you know that like it's so unlikely the Nasdaq's going to fall more than 2.5%, it's easy to call a bounce off of that line. That's what the 5% rule is all about. But whether it's now we look for a weak bounce or a strong bounce, now we recalculate. 7,400 to 7,200 is a 200-point drop. 20% of 200 is 40 points. So 7,240 is a weak bounce. 7,280, which is this green line, would be a strong bounce. So those are the zones you're going to look for to see if there's any movement. I don't think though. When you're down 2.5% and you bounce back to 2%, that's a 20% retrace, right? 2.5% drop times 20% is 0.5%. So you really don't want to, until you get past 2% here, regardless of what these numbers are, until you get past 2% again, you really don't want to mess around. These guys too, if they're down more than 1.25%. and he's down way more than 1.25%. They're all in a very, very bad zone. So anyway, let me know if that's unclear, or we can ask questions or whatever. So, do we have any real questions? Ken says, any thoughts on gold long? I don't know where it is at the moment, but yes, I like gold long as a general concept. The 1200 line is where I really like to get into gold. So here we are at 1190. So yeah, I think I have one. Full disclosure, I believe that's the only contract I think I have open right now is gold. YG. Yeah, one more. It's up 80 bucks. So it was 1188, whatever. So when it was just a bit below 1190, I took it. So yeah, I like gold, but obviously I don't love gold because I don't have 10 of them or anything like that. I just think it's a good spot to pick up one. I had silver, but it already made some good money, and I took it off. Silver, I had more silver than gold, and silver had a nice pop since I forget where I picked it up, probably around here, and it popped up to here, and I was like, I'm not going to turn that down because that was like 700 bucks. So I took that off the table, and I should have grabbed it again today when it went back down to the same place, but I didn't because I was busy. And that's where I am. And then oil. So what do we say? Gasoline? RB. So, I mean, 203 is really cheap for gas, and the only reason I'm not buying it is I'm pissed off I missed 201, 202. Kind of silly, because so what's going to happen? We have the hurricane right now knocking out, what do you call it? Then knocking out production, possibly of refineries in the Gulf. So that will cause some kind of draw in a week. So what we're saying is basically next week, it's not rollover week yet. Rollover is like the 20th, and this is the 10th, so the 17th. Rollovers might be Friday. There might be, here's how you know rollover. The 3 business days before the 25th. So no, rollovers are not until Monday. So next week on Wednesday, we'll have the regular report. Tomorrow there's a report, Wednesday there's a report, and right now refineries are being knocked out. So by next Wednesday, there should be a significant downturn in the production of gasoline. Also, the ships can't get through the port to the oil, so I'm basically convincing myself to do this. Also, the ships can't get through the oil, so there's really no reason not to take that trade. So let's go ahead and take one just for demo purposes. And I will buy 4. I will buy another one here to average 2025. And if it goes down all the way to $2 or something like that, I will buy another 2. But $2 I would really expect to hold. But for these purposes, I really want to just pick up one here, and there's a little profit already. So that was easy money. But you see, as I told myself into it, I got to think about there's no rollover until the Monday, so we got a long time until the rollover basically. And so that's the oil contract rollover. Gasoline contracts don't actually roll over until the end of the month, so even longer. But the oil contract can cause the gasoline contract to go down. So just conceptually, there's several factors that can boost gasoline. Tomorrow's inventory report may or may not boost gasoline, but if it's going to knock it down, and unless there's something significantly bad, it's already bad. It's already way down from last week. So it's not likely something so devastating is going to come along to knock it below $2. Any randomly good draw on gasoline will cause it to pump back up. So that makes me kind of want it for that reason. Also, there's clearly a hurricane in the Gulf of Mexico. That means certainly ships can't get into the Gulf of Mexico, and that means that they're holding outside the Gulf, and they're therefore unable to unload oil. So some oil imports into, especially where Cushing, Oklahoma goes, are being cut off right now. That's another thing. Second of all, there are refineries in the Gulf of Mexico, and if they get flooded out or shut down for whatever reason, then that's going to lower the supply of gasoline. Third of all, you've got all it's not oil, but still natural gas can go flying because a lot of the gas rigs are there. Plus the deep water wells are out there in the Gulf of Mexico, and we don't have that much production from deep water wells, but still it's a little here and a little there. There's a lot of little things that can curtail the amount of oil that's going in, and also curtail the amount of gasoline that's going to be produced. And also there's no rollover pressure. So there's too many reasons to play bullish not to do it. And there's 142 bucks already. That's just one contract. I freaking love these things. So that's a better play. You know, when you look at the indexes and you look for things to play, this is why I have this chart. Don't always look at one thing. It's like I have this chart to show me all the futures that I like playing. Not all the futures, obviously, but I like to play. I'll play the indexes, of course. I'll play oil, Brent. I want to watch Brent if I'm watching regular oil. I want to watch gasoline. I love playing gasoline. I love playing natural gas, but it's too high now. Gold, silver, copper, and the dollar. There you go. That's everything I play. I mean, coffee we play sometimes, but you know, coffee got high, so it's not even on my chart right now. So I always look for like which one of these things looks interesting now. And given all the news I'm reading, and don't please, if you're playing these things and you do charts, don't just look at the chart. That doesn't really tell you anything. It's a combination of looking at the chart and knowing about the hurricane and understanding where all the stuff is and the refineries are and all that. That gives me the confidence to go in and make a play. It's not about just because it was down at 202, that's a random number. It's because I feel the reward potential outweighs the risk. And right now, I assume it's just going to be consolidating below this line, trying to break over. But meanwhile, it's a next week play, so I'm not even going to really pay attention to it. Now, oil, for whatever reason, is jacking up, and so is Brent oil, so we'll see what happens. It's not, the dollar is particularly weak. Also, by the way, this is very bad. The dollar's down today, and all these indexes are down. So if the dollar comes back up, it's going to put pressure on all this stuff. So all this is not good. But like I said, we're going to be looking for the bounces and seeing what happens right now. Getting right back to 28.50 now, it's going to be key. See if we're going to actually recover. Meanwhile, I have no idea why we're recovering or what happened. But whatever. It's a silly market. That's why we're not playing too much of it. All right, so that was that question. Now, portfolio-wise, is this current? Wow, that's freaking great. 46, yeah, a little, still. I'm looking for like a weird one. No, wow. I was looking for like if there's a zero where there shouldn't be or something, but there's not. Okay, yeah, okay, well, it looks normal, wow. The options opportunity portfolio is doing quite well in the storm. That's great. Now, options opportunity portfolio is self-hedging. It's got its own hedges internally. And as you can see, this one's up $3,500, that one. Coffee finally is making a profit, which is amazing. We have Apple, ABXCD. This probably doesn't include the changes from last time yet. Northern Dynasty, no, that's it. That's a loser for sure. Walgreens Boots is doing nicely. That's a good one. Wheaton, I'm pretty sure we changed that one, so that should be better than it is. Anyway, so it's holding up very nicely considering. Very happy with the performance. So that's self-contained. The other self-contained portfolio is the Butterfly portfolio, and that's the same boring 38% it always is, always in that range. In other words, it's incredibly boring because all the positions are self-hedging, and it's probably a little bit lower than 38% because this Disney call should have been moved, and it wouldn't have been zero, it would have been higher. So that's going to cost some money on their roll, but other than that, it's close enough. So this is a self-hedging portfolio. Also, it's based on we sell a lot of premium, and when the market goes down, it does pretty good. Money Talk, 80% is very, very good considering, but again, also we have the hedge in there, although the hedge isn't really performing. But we do have the hedge in there, but I was very cautious and we went to very much cash, so there's not much for it to move in the market changes. The other two portfolios, the long-term portfolio and the short-term portfolio, the long-term portfolio starts out with $500,000. The short-term portfolio starts off with $100,000, 20% of the long-term portfolio. So you could do 120, it would be the same thing. The point is the short-term portfolio is there to protect the long-term portfolio. So what you want in the short-term portfolio is positions that will do well if the market falls. And what you want in the long-term portfolio is long-term solid positions. So, and in the LTP, we added a lot of positions to the LTP very recently because we thought that the market was going to drop, and I wanted positions that were going to make $100,000 if the market dropped to shore us up in case of a problem, and they're working like a charm because we're still up about the same that we were up a few weeks ago in the long-term portfolios. Our new positions are kicking ass. Let me see if I can find those. Home. Is it here? Oh, wait a minute, I'm sorry. Maybe, I'm sorry, we added to the short-term portfolio. We didn't even add it to the long-term portfolio. In the short-term portfolio, we added these positions, and they were here, 921. So I said, speaking of uncertainty, I said we should put some cash into the STP hedges and lock up these gains. The LTP was up 83%. It's actually doing better now. So one point, because because in the long-term portfolio, we made a lot of changes. Oh, let's talk about those. All right, we'll do that next. In the short-term portfolio, here's what we did. We added blah, 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 blah. I think we went over these last week. And the point of those hedges was we added all these hedges to the short-term portfolio, to make it stronger. But also in the long-term portfolio, or I believe in the long-term portfolio, butterfly, no, damn it. Anyway, I know we added a bunch of positions that were supposed to make $100,000. Where are they? Top trades? Professional webinar. I have no idea what's going on. All right, somewhere in here. No, that's not a top trade, silly boy. 9 trade ideas. Here it was from 926. Oh, that's why, because we did that review earlier. Okay, I'm sorry, it wasn't the LTP. That's the OOP, LTP, that's it. I'm sorry. So I was right. My concept was right. That's why the long-term portfolio is doing so well, because we added these positions that were designed to make $100,000 if the market went south. So the potential was $101,875 that we should be collecting by January expirations if all goes well. I said, and it won't, but it happened to be going, it couldn't go better right now. And that included, like I said, the CMG. That's why I was on that list, because we were talking about last week, including Chipotle, because in Chipotle, we sold 20 of the January 460 calls, and we're below 460. So these things are kicking ass. We're up $50,000 on those things already. And that's really offsetting a huge amount of losses in the long-term portfolio. But you see what happens? So in other words, on 926, I got worried, and we decided that because I was worried about the long-term portfolio, I said, you know what, let's do this. Let's add these 9 positions that can pick up another $10,000 each on the average, so that we have more of a cushion in case the market turns south. And that's exactly what happened a week later or 2 weeks later, and that's that. I mean, you can't do better than that, can you? So that saved the long-term portfolio from dropping probably 50,000 more than it has. And but the short-term portfolio, I don't know. I'm telling you, last time I looked, it was about 130. No, it was 160 this morning. So it was close to 160 this morning, 160%. It is now 180. So it made $20,000 today. So this is doing exactly what it's supposed to do. All these positions are there to protect the long-term portfolio. And of course, obviously, since they're basically bearish positions, they are kicking ass. Not all of them. I mean, the NJ position is a bullish position that we're trying out. But we sold these, we said, well, no, we have the bull call spread, and that's a straight up bullish position, basically. It's losing a little bit of money. Celgene is basically a bullish position. Amazon, bearish position, doing very well. IQ, oh wow, she's still playing with that thing? IQ's holding on. Why? I don't know what we're doing with that. I haven't thought about that in a while. I don't know why we left that like it is. Short puts are bullish, but then our main things are the hedges. So in other words, we've got this DXD hedge, which is up quite a bit there. We've got the that's weird. 95 now 95. Oh, no percent gain. Okay, sorry, it's flat. We've got this Microsoft bearish play, which is doing gangbusters already. Up $4,000 or $5,000. We've got this SCO, which is finally moving a little bit in our direction, but not still bad and still down a bit. I think we adjusted this, that it's not reflected yet. We have SQQ, gangbusters. I mean, look at that freaking $24,000 profit on that side. Tesla bearish, that was a great play. TZA also heavy spread, gaining money. And XRT was a bearish play on the retail we added recently, and that one's doing well too. That was in the post on 9/27. So, we in the short-term portfolio, we look for plays that are bearish all the time. And they're used because that way, when something bad happens, we get them and we cash them in when we feel it's appropriate. But then we take that cash and we put it into the long-term positions that we want to fix up. So I was going to say, let's take a look at these long-term positions. Home. Hope nobody's getting dizzy from this, because I sure am. Back to here, and let's look at the moves that we did make in the long-term portfolio. Because, so in other words, 926 was the market was very toppy when we did these reviews. 921, 925, whenever it was, the week that the options expired, like in September. I think they expired on the 21st, actually. So all these reviews were that week. And what did we do? In the short-term portfolio, we didn't make much change. I knew we did change that. We changed that SCO. We did something with TZA. Doesn't matter though. Oh, and then we added these extra hedges, which are not reflected here. So the short-term portfolio is actually doing way better, I think. Oh no, wait. TZA 10, 7, 11, 7. TZA 7. October 7th, 120, January 7th. Did we do that? Yes, we did, because look, we have 7 here. Oh, I know why. Because it didn't work because we did that. We called the same trade twice. So we had 20 longs here and 100 there. That's all. These should really be combined. See how these is the Aprils and the Januaries, but we had 100 Aprils already. So I just added 20 more to make that up. Anyway, sorry, so this does include those changes. These changes were called after the regular review on 9/21. So we did this review probably earlier in the week. This review is from the 19th. And so by the 21st, I got more nervous and we added a whole bunch of other changes. So on the 19th, we only made a couple of changes. And then on the 21st, I got a lot more aggressive. That's why. And you can see here, hourly. Nope, I can't see there. Oh, that's a shame. Anyway, as the market stayed toppy, on the 21st, which is probably back here, I said, screw this. I just don't see us going any higher. And I said, I want to add all those extra things. We got a lot more bearish. So we got much more bearish in the short-term portfolio, much more bearish in the long-term portfolio by selling all those January calls. And that's what saved us. That's what's saving us right now. Now it's a 400-point drop on the Dow today, and we're like, ha, ha, ha. So what were the moves that we made? No, not those, these. So when we got to the long-term portfolio, what kind of moves did we make? First of all, very, very good move. We had a lot of open puts, and I'm worried about a market downturn. We had a lot of puts that were up 60% or more. I closed everything that was up 60% or more because, first of all, they're generally 20/20 puts. So the most we could do is collect 33% of the money between now and 2020. It's really not worth it. We've already got we have a gain of 2/3, and we can close it right now and be done with it, or we can sit here and tie up the 2/3 for 18 more months waiting to close them out. So rather than do that, considering we had, if I have any uncertainty, because if I'm going to leave them open, then I have to spend more money hedging against them. So what's the point? Is I just take the money off the table, have the cash, and it lowers my need to hedge. I don't have to worry about them anymore because they turn into cash. So there's two good reasons to cash out. So all we did, it wasn't very scientific. All we did was cash out all of the ones that were going well. So I said, we're up 15,000. Okay. What did I say? Oh, not that anything wrong with any of them, but they all have less than 40% to give us between now and next year. We can replace them with short puts that will give us 100%, right? Any short, I can take any short put on the same thing, and it's going to give us 100% of what we're putting in, not 40%, because we've already got the 60% of the position. But instead, obviously, since we felt the market was toppy, we wait for a nice dip and get back in. So all the ones that we took off here, Berkshire, Blackstone, Cleveland Cliffs, CVS, Facebook, RCL, Sigma, any of those that we like, these now go on the watch list. They basically transfer to the watch list, and now if they get cheap again, we jump back in. That's all. It's a very simple process. It's not that we don't like them. It's that they gave us 66% in a very short period of time, in less than a year. And so we say thank you, and we take it and we go, and then if they happen to get cheap again, we'll buy it again. If they don't get cheap again, we say, oh, well, we played it, we had fun. That leaves us with basically the underperformers, but of course, obviously, we also looked and said, you know what, I still like Whirlpool, even though it's performing like crap. I still like C, I still like Starbucks, I still like NXPI. So even though they weren't performing that well, I'm willing to double down on them if they get worse. That's very key. If you're not willing to double down if they get worse, you should be taking them off the table. But the point is, we cash these out. That relieves a huge amount of margin pressure from us and puts cash in our pocket. So where's the downside? There's no downside to that. So when you get nervous, that's the kind of stuff to look for. What can I get? Where can I eliminate risk? Not just where can I take profit, but where can I cut my risk down? What positions can I cash out that'll take risk off the table? There was a lot of risk to the short puts. And we cut a lot of short puts. It's like 7 of them. 1, 2, 3, 4, 5, 6, 7, 8. 8. No, wait. 1, 2, 3, 4, 5, 6, 7. Yeah, it is 8. 8. 8 puts out of whatever. About half. We took off half our puts practically. So that was great. Now, since then, we've added a couple of short put positions. Why? Because we had the space. We saw a couple of nice bargains we picked up because we had the space. It's always a push and pull with a portfolio, and you've got to adapt to the market conditions. So Apple, we did a roll, and ALB, we did see we did. Let's cash out. We had these $75 calls that would deepen the money. 75, it's at 100. So we had these $75 calls that were deep in the money, and we thought that it might pull back. Don't forget, this is this week. Back here, they were at 105. And we said, you know what, let's take that off the table. That's a pretty good run. Thank God we did that because it's all the way back down to 97 now. And what do we replace it with? We replaced it with a nice spread in 2021, but because we have a 91.20 spread, That's not going to be very affected by this little move because it's way out here in date. It's way out in 2021. So this doesn't really affect this spread over here. Could care less right now. And also very nice, we sold 5 January 110s. That was key. The 110s were here, we were here. I said, you know what, again, we thought we'd be rejected around this line. So we said, let's sell some 110s because it's that landlord thing again. It's like, why would I have a property, and my property is my AOB longs that I hope will appreciate in value, but meanwhile it's sitting there unused. And against my property, I can sell some short calls and collect rent. So why would I not do that? Especially if I think the market's going to go down. If I'm wrong, I just roll the short calls and roll the short calls and roll the short calls until they finally expire worthless, or I'm forced to buy more, God help us, more longs. But since I'm only selling a quarter cover, it's very unlikely I'm going to get burned on the short calls. So there's basically no reason not to do that. It makes no sense not to sell those calls. And any of you guys out there who are sitting on a big retirement portfolio, oh my God, poor Panama City. It is the hurricane is going right, the center of the hurricane is going right over Panama City. That is awful. This is a very, very strong story. Anyway, what was I saying? Oh yeah. So anybody who's got a retirement portfolio or a large portfolio with long-term positions, I don't care how much you love them, it's like an unrented apartment. It's like it's like, fine, I understand you think it's going to go up in value over time, but that doesn't mean you shouldn't rent it out while you're waiting. It's a waste. If you're just leaving money on the table for no reason whatsoever. Oh, geez. Gee, we are letting down. Very ugly. That's not going to be good for my gasoline, is it? So what happened? My money's gone on gasoline? Where are we? RB. Oh, damn it. All right, that's okay. I said I wanted to go for the long haul. This is a bad turn, though. People are panicking to the dollar, and that's sending everything back down. So if you're going to short now, we want to short the Russell as things seem to be breaking down a bit. If you really think they're going to go down, you want to look at the Russell for a possible short. Oh, my beautiful profits. Look how fast they went away. Now I'm down 155, you bastards. Anyway, so here's the NASDAQ. We'll forget about gasoline for now. Just got to remember, I want to add some more if it goes worse. Here's the Russell. And where do we want to short the Russell? How bad are these guys looking? It's pretty bad. See, that would have been nice. I would have liked that 72.50 short. 28.50 lit right on the nose. 28.50 failed. See, had we not been yapping away there, we could have done that. Anyway, if I was going to short, I'd short the Russell, but I'm not that enthusiastic about it. Plus, I'm not going to be able to watch it because we're having a serious conversation. So let's get back to that. So if you've got this big portfolio full of stuff, it's a single thing that pisses me off more than anything else in the world. And they have all these people, they have all these meetings with retirees and tell them about this and that with the stocks and what they should be doing. And I just feel like getting up and screaming at these people. I'm like, what are you people doing? You've got $500,000, $1 million worth of stocks, and you're getting freaking dividends from them, and you're scraping by when all you have to do is sell some goddamn calls. It's not complicated. I'm not talking about teaching them the whole system that we have. That's crazy because you can't expect all these 60, 80-year-old people to be learning new things like that. But for God's sakes, just sell a goddamn call against your position. You can double your freaking income from that, triple your income from that, just by selling some calls. It's not complicated, and it can't hurt you. The only hurt you can get is it'll pull your stock away, and you'll have a profit, and then you'll buy something else. That's the worst thing that can happen to you. Crazy, crazy thing not to do. It drives me nuts. Anyway. All right, what else do we do? Amgen. We rolled the short. Okay, we rolled the short 190 calls to more of the. So you basically even roll to the January 200 calls. So that's good. And we're still less than half coverage. So we've done, we've done a similar thing what I said on the bull call spread, but in this case we got burned to the upside, but I think it's fine. So we roll, and we've had 15 long or whatever the hell the position is. We'll take a look. Amgen. Yeah, 15. Boy, do I have good memory. So we had 15 long, and we had 5 short 190 calls, and we rolled the 190 calls to a larger amount of 110 calls. Of 200 calls. So we rolled in 190 calls to longer to January, from September to January. So we had more time, and they cost more money, and we rolled out to the 200 calls. And we're still only half covered. That's what I meant by that. And so if that expires worthless, if we did down to 200, we pick up this $8,500. That's profit. And we still have our long position. And I like that too. We brought back, oh boy, that's smart. We brought back the short puts because we said this is toppy. I like Amgen, but just because I like it, here, look. I love my daughter Jackie, right? And I love them both, in case Maddie's listening. No, but I love Jackie, okay? But she was in the All-Star game for softball in her school, and she had an incredible day. She was the MVP. I mean, hit home runs and all kinds of crap. She was the MVP of her All-Star team in the All-Star game. She got the MVP, and it was fantastic and blah, 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 blah. And that's great. She had a great day. She had a fantastic, they had a whole great season. We had a great day, great season, whatever. Okay, that doesn't mean that the next time she plays, I'm going to bet on her to hit 3 home runs and score and have 8 RBIs and be a great fielder and all that crap. It's like I don't anticipate, just because I love her and just because she's capable of performing fantastically doesn't mean I'm stupid enough to bet that she's going to do that every time. She had a great game on a perfect day to do it because it was the All-Star game, and it was fantastic. But I don't go in the first day of the next season going, my daughter's the greatest player in the history of this game, blah, blah, blah. No, she had a great game. Now let's see how she does next season. Same goes for stock, okay? We had a great run. We blasted up from this. This was too cheap. I thought so. That's why we got into it. It was too cheap. Should have been about 185. We had a run where 165 to 185. It came back to where we thought it should be, and then it went the other way. It swung the other way 20 bucks. Went 20 bucks too low, now it's 20 bucks too high. You got to realize that, though. And so, again, even though the short puts were 2020s, we knew this was too high. So let's buy them back. Let's get out of that. Wait for a pullback, and 2021s where we'll sell those and get more premium. Okay, your portfolio goes up and down and in and out, and if you learn the rhythms of all your stocks, you will be able to play them much better and much more efficiently. That's all we're doing. We're just playing the range we see. Top of the range, top of this range. See these 2 lines? Top of the range, bottom of the range. Market's weak, so I'm not jumping on a put sale, but we'll see what happens. It doesn't hurt us that we don't have any short puts. We're worried about the total market. We're going to see what happens. All right, no questions. You guys are amazing. Or I'm amazing. Maybe I'm an amazing teacher. All right, let's see. BJO. Up in the long-term portfolio, we took the loss. Wow. Hope we didn't take it in the OOP. That's a shame. In long-term portfolio, we did this. That's error. So I gave up on BJO. Here's where we gave up on BJO. Oh, makes you want to cry. Okay, well, can't always get it right. It was just very frustrating because it wasn't. Look, this is frustrating. This has been frustrating, and it just wasn't going anywhere. We went along on the coffee on the KC contracts; those did great. But we gave up on BJO because it just was not going anywhere and didn't look like it was improving. And all of a sudden, boom, took off. Maybe it was us. Maybe when we got out, that freed up enough, that took off enough of the contracts that they were able to take it out. Yeah, I mean, that was a terrible, terrible timing on that call. No, that's not it. That's it. CDE, we pressed that bet. That was good because CDE took off. Oh. CDE. Oh, it didn't take off. Sorry. Anyway, it's stayed put, but it's. I like them. I think they're going to do well. But you know, that's what we do. It's like if you think a position is still good, we put some more money into it because it's a very small position anyway. I mean, 50 times 7, 5,000 times 7 is all right. Yeah, 30. It's gonna be $35,000. Not terribly small. It's gonna. We're rolling to 50 of the threes of the three spreads. We don't have a lot of money on this thing, and we think it's going to improve over time. Disney, we let the short calls expire. Ford, we bought back the 1187 calls because they were so cheap, but Ford's actually getting worse. Ford is horrible. All the way down to $9, but I you know, it looked actually we looked smart for a minute, but then we looked dumb. Ford's down to $9 now. See it's still down here at $9. When we get to the next portfolio adjustment, I'm certainly going to be doing a lot more for. Actually, that's next week. So chances are next week we're going to be pressing our Ford bet significantly because that's a fantastic price on them. GE, well, that's good. Same thing. We took a bigger position in GE, a much more aggressive position. We took 80 of the 2021 10-15 spreads. That was great timing. Because wow, no wonder the LTP is doing well. Like we had some real good picks here. GE, and you know the things that haven't improved for ages. But GE was way the frick down here, and I was like, I'm sorry, we just got to buy more. I can't not buy more when it was down there. Now it popped up. We'll see if it holds. Could go back down again, but I like them. I like them for the long haul. IMAX, what do we do with IMAX? We rolled the 23 calls to some short calls, blah, blah. We cashed in our 18 calls and another one. See, the 18 were too far in the money. They're $7 in the money. We had to cash them in there in September. And we picked up, and then we added more. So we said, well, that worked out well. So we're going to pick up 20 of the 2020s. And we have a new ball club spread now. We love IMAX. It's so much fun to play in the channel. It is so good to play in this channel. It's so obvious when to take money off the table. Right here is when we took money off the table. And down here is where we'll sell more puts. And up here is where we'll sell some short calls. It's not complicated. It's really good in the channel. And it's very stupid because people buy and sell IMAX based on the box office. And that's like if you bought and sold Kodak because your mother took a good picture that week. You know, she's like, yo, my mom took a lovely picture, so I'm going to buy more Kodak stock. And now my mom took a bad picture, her thumb was in there, so I'm going to sell the stock. It's not IMAX's fault if the movies are good or bad. It doesn't change IMAX. Could you imagine taking the same logic would be to take the movie seat company, the company that makes the seats in the theater, and say, oh, you know what, if the movie's bad, I'm gonna sell the seat company. It's stupid. You know, yes, they do have some tie to the box office. They do get a kick of the box office, but it's not their main business. Their main business is in building and installing theaters, giving people the system, and renting out the cameras they make the movies with. Now, if they stop making movies in IMAX, if the film companies decide they don't want to release things in IMAX, then you've got a problem. And once in a while, this is like what happens to Taser and what happens to TiVo. Once in a while, somebody comes out with what they say is a better mousetrap. They say they have a better system. I forget which rival. It might be AMC, but somebody in Europe or Wanda. Yeah, Wanda, Chinese, of course. So Wanda Films or Wanda Cinemas in China and Europe, they started to have a new format that was IMAX-like, a new high definition format that was IMAX-like, and they started building theaters with it. But the problem is, you can't be kind of like IMAX. There are an entire generation of cinematographers and editors and directors who love IMAX, who dream of working in IMAX, and they don't want to learn a whole other system. Even if it's very similar, it's still a whole learning process to get in there. You're not going to easily get people to change and move over to something when IMAX is already accepted in thousands of theaters. And yeah, Wanda has a big advantage because they have their own theater chain, and if they want to spend billions of dollars, they put their theaters with this system. But you still got to get somebody to commit to filming in it. And you know what? You go to Steven Spielberg, who's been doing IMAX his whole life, and you say to him, and he's been doing IMAX his whole life, works with IMAX, and knows every single thing there is to know about them. And if he has to help his directors in the films he produces, he knows exactly what to do. He knows what the problem could be or wouldn't be. He knows how to fix it. He knows how to pick up the phone and call the guy at IMAX and whatever. There's a lot to it. And films are critical, and timing is critical, and everything has to work all the time. You don't have time for defects, and you don't have time for problems. You know, IMAX knows how to deal with the film industry. They've got decades of experience. And also these directors come up making, you know, the ones who learn IMAX, they come up making nature films and things like that, like that you see in the planetariums. So there's a lot of work in IMAX for small budget people. But when you go commit to brand X on a $200 million movie, because you don't do IMAX for small movies, you go to brand X for a $200 million movie and it fails, you got lots of problems. So it's not that easy to dislodge IMAX from the theaters, but a lot of times somebody announces something and people panic out of it. So that's fine, because we don't care, because we know when it goes down for those kind of reasons, it's stupid and it'll wear off, it'll shake off. We know when IMAX goes down because there's a few bad movies coming out. We don't just assume it, but we look ahead at the schedule and we say, oh, you know what, the schedule looks pretty good going forward. And that's what we care about. We're like, what's going on in the future? What's going to happen? Are movies over? Is nobody going to go anymore? And that was a narrative a couple of years ago. Everybody, people saying, oh, movies are finished. Everybody's watching TV now and whatever, or smartphones, or Netflix is killing the movie industry. Meanwhile, they're having like their best year in ages, you know, for the box office. It's about the films, and it's about the experience. And then I know in Delray Beach, they're building this gigantic movie theater. It was one of the biggest projects going on construction-wise down in Delray Beach. It's this movie theater they built in the middle of town. People are still going to movies, and especially the high-end stuff. So anyway, that's why I like IMAX. It's always good because it's very volatile, but you can always count on them in the long run. LB, not having the time we were hoping it would have, but we also got more bullish on that because again, when it's down, we want to buy more. So down here, we started buying more. Hopefully, it'll stabilize and come back. MT, we cashed in our longs, thank goodness. Here we are. I freaking love it. We cashed in our longs at the top because we're not idiots. It was toppy here, and it came toppy again, so we get out. You don't assume it's going to keep going up. That's stupid. So now it's down again. I mean, you know, and obviously there was the overhang with trade and whatever. We went to a safer spread, and that's where we are. So we're done with that. And who else? Pisa probably doing. How's that? PZZA. They got to be doing good because they got a buyout rumor now. Yeah, look at that. That's great. So we were here, and we just, well, we didn't do anything here. We bought it here. That was the key, is we got in over here when they were having all that turmoil. Qualcomm, again, over our target, so let's cash in the longs. I want you guys to get this mentality that this is how you do things. It was over our target. And again, really nice. We'll be a little bit late on that one maybe, but right here, over our target, so let's cash it in. Not sit there like an idiot. So we cashed in our longs, we picked up a spread which is much less volatile, and we have two-thirds covered of the spread, so we're fine. I said, not bad, because we started off with $2,300 and we just cashed in. We cashed in 30,000, and we still have the spread left. So we only put in 2,300 cash. We just took 30,000 off the table, and we still have a spread. Well, not 30. We took 30 less 11. So we took 20,000 off the table from 2,300. We still have a spread that's worth 26,000 more. So this can become a $50,000 winner off a $2,300 spread from 6 months ago. And all we're doing is working the trade as it moves along in the channel. We're not making drastic moves, and we're not trying to time them. And also, again, everybody freaks out. You're always watching things all the time. What do we do? Generally, we don't do anything except for expiration weeks. And that's not because it's that's not because it's a certain magic about expiration week. It's just because that's the week I like to make my adjustments, because I have to have consistency so that people know when to come back. Because we have a lot of guys who only tune in once a month to see what's going on, to see if there's any changes to their portfolios. A lot of our guys are boat people, you know, like they're constantly on trips, they're away, they're traveling, whatever. You know, Yodi lives in an RV. He lives in an RV. He's like traveling around the world with his, but he's linked up. He's got a satellite. But a lot of people are just out. One of my mom's friends, who's also a member, she lives on the world, and that incredible like yacht that travels the world. It's not a yacht. It's an entire cruise ship. That's every cabin is like luxurious, like $1 million plus cabins. She lives on that boat. And she plays quarterly. She only wants to know about quarterly trades. She doesn't even want to make an adjustment monthly. She makes a quarterly adjustment. So I don't want to constantly make adjustments when I can avoid it. If something happens, we'll make an adjustment during the month. But usually for an adjustment, I just wait until the end of the month. I don't sit there. You don't have to go crazy worrying about every single trade all the time. If something happens, if news happens, if something changes, sure, make an adjustment if you think it's valid. But as a rule of thumb, though, it's fine to just focus once a month, sit down, focus, make sure you go over everything in good detail. That's what we're doing here. But you don't have to over trade. You don't have to constantly be freaking out about everything. It all kind of works out in the end. Even crazy stuff like this, it's like we were able to say, because knowing, also, in fact, I'll tell you, knowing that I wasn't likely to make an adjustment between last month, the 21st, and this month, the 17th, or whatever it is going to, wait, what's today? This Friday will be the 12th, so the 19th. So the 19th will be the next time that we do these adjustments, so next week, obviously, during the next week. But so I knew from the 21st to 19th, we weren't going to be making adjustments. I didn't like the way the market looked, so we made bearish adjustments. Because if you're going to stare at these things every day, you tend not to think ahead like you should be. But you really should be planning your next month, not planning your next day. And that's what a lot of traders make that mistake. So when we're taking all this cash off the table, because I have a month-to-month mentality. We're selling short calls because I have a month-to-month mentality. Because I say, how do I feel right now about the next month? And we felt nervous about the next month, so we made a lot of moves that are very, very bearish, and that has so saved our portfolio. But it's because we don't have a day trading mentality. We have a long-term mentality, and we protect ourselves for the long term. We cashed in. I'm so happy we cashed in all these things. It's fantastic. SKX, we were supposed to sell the January 28 calls. They came back near 3, so we did get rid of them finally. And that's now going down. So if you haven't sold them, you better sell them because it's probably going to go lower. Wheat and precious metals, that's silver, of course. So we were up here, and I said our 2015 calls are 355. I don't want to sell unless they go below 325. I don't think they have yet. So you're at 1,200, no worries, we're stay over 17. I want to add 50 of the 2021. So we added another bull call spread. We protected this with a stop to sell it to protect our gains because we came in low. And we added 50 new spreads, and that's our roll. And And oh, I see it. And I said, well, hopefully we can get 375. So hopefully we'll get up to 375 to cash in the 15 calls, and that will then pay for the roll that we did to the new spread. So if that pays for the roll, then we're in good shape. Now, up BJO. This one is turning ugly, BJO, but it's March. Oh, yay. See, in this BJO, we saved it. So I'm glad in the OOP, because in the LTP, it wasn't a big loss to take. In the OOP, I would have been pissed off if we missed out on that turnaround. So we have a very, very nice turnaround in BJO. Whew, that was a lot of review. All right, what's going on? You guys hear me? now I'm worried we have no questions. Oh no, don't tell me something's wrong. Hello, anyone testing? Oh, market back to lows. Thank you, Tom. Tom's alive. All right, so market back to lows, which means that we're glad we didn't take that long position. Wowee. Ugly, holy crap. We're gonna be down like 500. That is down, the futures are down 500, see that? So I look on CNBC, it's only down 475. Wow. Oh, oil, wait, oh, not oil, gasoline. Okay, so now RB's down, but the market's collapsing and everything's a mess and the dollar's getting stronger, and I had a plan which I'm sticking with. So now we're at 202, and I'm gonna buy one more. Hopefully, down 500 bucks now. Oh, come on, man. There we go. All right, so now I have two, and my average price is 202. So my average is just really right there. It's not a big deal. And I said if we get all the way back down to 201, if we go to 201, I'll add two more, and my average will be below 202. Now it's 202 and a half, basically. So either we get back to 202.4 and I cash one out, and then my long will be at 202.4, or if we go lower, if we go back down, we have to go at least 4 below 202, so that my average will be 202. So it has to go to 2006. So down around here is where I'd want to start, is where I want to double down, because I want my average to be below 202, because that's a line I feel pretty comfortable about holding on. So that's not likely to happen. No, I'm sorry, it's not 2016, it's 206. It's really, really far down. So it's not going to happen most likely. But if we get to no, I'm sorry, it is 2016. Silly me. 2016 is my goal, which is basically right about where it was here when it was at the lows. So if we can get to 2016, that'll make my 2024 average out to 202, and that way I've got a nice number that I don't mind holding at. So I have 4 long at 202. If it keeps going down, if it goes up, I'm going to have 1 long, ironically. If it goes up, if it goes the way I want it to go, up, I'm only going to have 1 long at 202.4. If it goes lower, I'm going to have 4 long at 202. But you've got to have that discipline. You've got to have a discipline. You've got to keep your positions under control, and you don't want to overdo it on size. The only reason I want to have a heavy position on gasoline is if it's really cheap. If it's only a little bit cheap, I don't want to have too many. So we'll see what happens. Holy crap. Oh my God, look at this thing die. Everyone's good. All you guys are good with your hedges. I'm so happy. Ken says we're all trimming our portfolios. Everybody's selling while I'm talking. And Jose says just absorbing your wisdom. Thanks, Jose. And Mike says it's a good webinar, just absorbing information. Wow, that's interesting. Both of you said the same thing. Anyway, so good. Okay, so yeah, it was a lot of stuff, and I just wanted to get that point across because obviously this is the time to do it. But also, if anyone needs any help, I asked this earlier. Nobody asked me. If anyone needs help with hedges, or are we all well hedged? Everybody's kind of following what we're doing? Because that's great. I'm thrilled. I mean, not that I haven't been banging the table on hedges all year long. Down 500 now, you know, officially from the CNBC. Wow, this is horrific. So everybody's heading down like 2.5%. Now, Okay, here's another very important point. When you see consecutive periods, doesn't matter what the period is. So in other words, if you're looking at a daily chart, it means consecutive days. If you're looking at an hourly chart, it means consecutive hours. If you look at a 5-minute chart, it means consecutive 5 minutes. Okay, it doesn't matter what period you're looking at. But obviously for the market, we're generally looking at days. So when you see consecutive days where the market goes down in the 5% increments, if it goes down 0.6 and then it goes down 1.25 and then it goes down 2.5, then the drop is accelerating. And that means that it's very likely to keep accelerating, or in the very least, it's going to decelerate at the same pace. So if you go down half a point and then 1 point and then 2 points, okay, that's 3.5 points in 3 days, let's say. It's very unlikely that you're going to go up the next day. What's more likely is that you'll go down another 1.5 points to the 5% line. And how would that happen? Because you go down half, 1, 2, that's 3.5. Then you decelerate down 1, decelerate more, down 0.5, and then you'll find a bounce at the 5% line. So you look for that also. Look for accelerating or decelerating drops. And even in the course of a day, you want to look for accelerating and decelerating hourly drops or minute drops or whatever. But you also want to look for bounces off the lines. Now we hit the 2.5% line, and on the S&P, that's very significant, obviously. When you get down to a major line, you want to look for a bounce. Oh, see, we're bouncing already over here. That's nice. Now, is that because of the dollar? I don't know what that's because of. Where's the dollar? Yeah, the dollar stopped going up, but not much. See, RB's coming off the same spot. I really like RB long here at the 202 line. Really like it. Oh, my gold's doing good. Gold's popping. Okay. Let's see if gold cheers me up enough to offset my RB. YG. Ah, wish I had more of those, right? 150. That's not bad. We were like 18 before, right? So it's coming up nicely. I bet RB recovers by the end of the day. I think these guys are silly. I think it's crazy not to be long on RB with a hurricane and all that crap. But anyway, so, oh yeah, accelerating and decelerating, right? That's what I've been talking about. So let's take a look at the chart, not that chart. Let's take a look at, not that chart, this chart, yay. So this is what I mean by, so see this accelerating? You know, here's a period down 10, down 20, accelerating, down 15, decelerating a little bit, comes down another 5. So now you can say, okay, it's relaxing, it's getting better, right? That's what you want to look for. Is it accelerating or decelerating? So here, accelerating, that means it's very unlikely to do more than weekly bounce, which is what it did, and then it continues its fall. Because you have this, when you have an accelerating move in 2 consecutive periods, it doesn't usually just turn on a dime. It's got to decelerate in some sort of fashion. We do hourly. Take a look at the hourly looks like. And here's the hourly. This is not good. You got these are 20-point periods. So here's 20. Here's 20. 10-point bounce, not enough. Here's 20. 10-point bounce, not enough. 20. Bounce, not enough. Bounce, not enough. 40. So this is accelerating. In the big picture, we are accelerating to the downside. This is a kind of cascading failure that can lead to like tomorrow being down 80, which would be catastrophic, of course. So now I want to go to see a bigger chart and say, well, wait a minute, that seems unlikely. That seems like a real 80 points is a lot on the S&P. So is it really going to fall 3% in a day? Well, it can certainly fall 2.5%, right? We know that. 80 would be down to 50 to 2860, basically. I mean 2760. So right here. So your next support, if it's going to cascade down, a longer candle here. More likely though, it'll only fall to 2,700, which is 40, which is basically the same move it's having today. And it'll hit 2,800. And then it should start, hopefully it might pass that line, but it'll decelerate there and flatten out. It'll still get to that 80, but it's probably going to flatten out. So probably, unless we turn around sharply here, we're probably heading still down to here. And if you short that on ES from 2740 to 2780, 2840, 20, that's 60 points. That's $3,000 per contract. So there's still a lot of money to be made on the short side. And you see this one? That's a good example. Look what happened. Long, longer, little flat, longer, and much longer, but a big bounce off of that one. Then it sort of consolidates, moves back up. But then all the way back to test the bottom again after that. But you see what I mean? The same move in a shorter period is also an acceleration. So here's a here's a 100-point move, and it took 2 months. Here's a 100-point move that took a month and a half, and here's a 100-point move that took a month, getting faster and faster. That's bullish. So time and space are both relevant. Okay, so think about like how fast it's moving and how much it's moving, and then think about whether this is accelerating. Is it getting faster? Is more of a, you know, think about like physics, like there's something pushing it. Doesn't matter what's pushing it. Some force is pushing this thing faster and faster. So it can go up over shorter amounts of time. It can go up to a higher amount over the same time. Either way, it's the same thing. And on the way down, it's the same thing. How fast is money being pulled out of this thing? And if money is being pulled out of something faster and faster, and this is what the 5% rule kind of measures, because when you clock it on the machine, the 5%, it's going to pause at 5%, pause at 5%. But at a certain point, the amount of buying interest overwhelms the amount of selling interest overwhelms the amount of buying interest. Of the, you know, these buying computers are dip buying, and so are people. There's plenty, you know the dip buyers, right? They don't jump in and think they're geniuses every time it dips. But at a certain point, they get frustrated, or it gets too much, or they run out of money. You know, sometimes there's more sellers than there are buyers, and especially in this incredibly weak-ass rally that we've had, it's so easy for a major sell-off to occur, which is happening now, which is what I've been saying this all summer long, haven't I? All summer, as we've been up here, ever since here, in fact, where we cashed out a huge amount of positions, I've been saying too high, too high, too high. I was wrong, but I'm not wrong. It's still too high. This is where the market should be, not here. All this was wrong. I mean, you can't make money on the way up. We sure did, but I'm saying it's just wrong, price-wise, value-wise. It's wrong. It's too much. You're not taking into account all the crap that's going on in the world. Wow, the 10-year note, we had a bad auction today. 10-year note, 323. It's a freaking disaster. 323 for the 10-year note. We just had a big auction day, $20 billion, terrible participation. People don't want our money at that price. So there's lots of, you know, it doesn't matter if corporations have great earnings if there's a lot of problems in the world that can impact those earnings. And there are a lot of problems in the world that can impact the earnings. So those earnings are at risk. It's always, you know, we had that in 2008, we had the same problem because everybody projected these amazing earnings going forward. And you know how the Case-Shiller has more conservative PE ratio? That's the one I always go by. Because you've got to look backwards at what they actually earn, not going forward at what they think they're going to earn, because God forbid something happens, they don't earn it. And even the prior earnings, if something happens, they might not earn that either. But you got to have a realistic expectation of earnings. Your estimate should be conservative, not optimistic. You know, when I go like the PSW Investments, we bought this pot company, marijuana producer. Great company, had a lot, every reason in the world to buy them. But when it comes to valuation, and of course, I obviously want a lower price when I'm buying the guys. But I said to him, look, you say you can do all this crap, and then you're going to double your business, and it's going to be this and that, and you want me to take a very low valuation. And I'm thinking, what if you don't, though? Then what have I got? Then I gave you $1 million, and you're not cutting it. You know, if I'm gonna hand over $1 million to you to buy a bunch of equipment that you say is going to double your revenue, you can't tell me that my valuation has to be based on you doubling your revenue. You can't double your revenue unless I give you the money. So it's my doubling the revenue. It's not your doubling the revenue. So what we did is I said to him, I said, look, here's what we're going to do. We're going to do what they call a clawback, which means that we're going to take to start 27.5% of the company. And if you do well enough to give us all our money back within 3 years, so in other words, if we get a 33% return on our money for the next 3 years, then we will drop our take from 27.5% to 16%, 16.5%, something like that. We will drop a portion of our take because you did all the crap you said you could do and your company expanded the way you said it would expand. If you don't, though, I'm going to own a bigger portion of your company. And that's how you buy something. You have to buy something based on what actually is going to happen, not what you hope is going to happen. And so by coming up with that, I was able to make a compromise that made everybody feel it was fair. You don't do that with a stock, though. A stock doesn't negotiate with you. You have to negotiate by saying, I'm only willing to pay this. I'm not willing to pay your promised amount for the stock. I'm willing to pay what you earned, and assuming you don't have such a good year next year or the year after that. That's why when I pick a stock like Limited Brands or something like that, I want a stock or GE, when GE was down, I want a stock that people don't think is going to do well, that's priced down, that I think is going to do better. I don't want to chase into somebody who's high-flying stock and whatever, go after them, because everybody thinks they're going to do great, and if they don't do great, that's going to be the surprise. Well, gasoline, everybody seems to think gasoline is going to be doing terrible for the next 2 weeks. I'm like, I don't see why they would have a bad week this week coming up. I think it's going to be a great week for gasoline. I think a lot of factors can make it in their favor. But you've got to be logical and you've got to pick up the bargains, not chase after things that everybody's already piling into. And that goes, and the same thing, by the way, why do we keep buying those puts? Why do we keep putting money into the short positions? We always took a certain portion of the profits from the long-term portfolio. Not physically, because we have plenty of money in the short-term portfolio, but we would take some of our cash, whatever profit, phantom profit, paper profit that we make in the long-term portfolio, we would take a third of it, roughly, and put it into short positions that would pay 2 to 1 in the short-term portfolio. So if I make, if the market goes up and I make, it doesn't matter what the percents are. What matters is, let's say I make $50,000 in the long-term portfolio because the market moved up $50,000 in a month. So from August expiration to, from August expiration to September expiration, we made $40,000, let's say, in the long-term portfolio. Okay, that's great, but they're all big bullish long-term positions. So I take $15,000 of that and put it into hedges that will pay me, pay 2 to 1 at least if the market goes back, if the market falls. So now what happens? So now if the market does fall, my 15,000 becomes 45,000, and the long-term portfolio gives up its 40,000. So now in my short-term portfolio, I've got $30,000 cash offsetting the $40,000 loss in the long-term portfolio. I've maintained 75% of my profits, even though the market has dropped back and all those gains were wiped out. I've maintained 75% of my gains. Why? Because I realistically thought to myself, this is not how you make money, which I said last week or the week before. I know I said that. I said, this is stupid. You don't make money like this. It's not right. You can't have a $500,000 portfolio that makes 10% in a month. It's ridiculous. Because if everybody made 10% a month, money would be meaningless. This would be Zimbabwe, or this would be Brazil or Argentina or any of those hyperinflation countries. You can't make 10% a month. You can make it if you're really lucky, have a great month and whatever, and special thing. But if everybody in the market is making 10% in a month, if that's how it's paying, or not everybody, but the options players like us, if everybody, if it's that easy where we can make it, hundreds of other people can make it, thousands of other people can make it, then that's billions and billions and billions of dollars being made by people for doing nothing, for just sitting there playing with the stocks. It makes money worthless. You're creating money from nothing. And it's going to come back and bite you anyway. It's going to bite the economy. And my big issue with the market all the way up has been it's very thinly traded, and you're not really pricing these companies at these values, because you're pricing a stock, the price of the stock is based on the last transaction of the day. But that last transaction, if it's 1,000 shares, if it's 10,000 shares, it still is nothing for companies that have millions of shares outstanding. And what you're doing is you're pricing millions of shares on what happens to 1,000 shares. It's statistically meaningless. And when a stock goes up and up and up in very short succession, and you know that there hasn't been enough time for real money to actually go into this stock at that price, then it's mispriced, and the price is meaningless, and it can unwind very, very fast. And here it is. Look how fast this unwinds. The entire summer of trading has unwound in a week. And that's why I was so annoyed with these record high, record high, record high. It's ridiculous. You know, and I worry about it because I've seen it before. I've done this before. It's the same thing here. We cashed out our long-term portfolio last year. We did a new long-term portfolio, and we cashed out our old long-term portfolio here, and then we started buying again here, and then we took advantage. Fortunately, we got some positions here, but then we went crazy buying stuff when it went down here. That was exactly the pullback we wanted, and we had a very good year so far. But point being that into the uncertainty of Christmas and New Year's, I didn't want to be in like that. And then we had a little bit of a sell-off in January. I said, okay, let's start buying, because I felt like, okay, we're going to miss a rally, which we would have. And we actually went a little crazy at the beginning because we bought a lot more than we should. We didn't go slowly into the new positions. We were ready for this pullback. That's how the short-term portfolio made so much money, because when we were going up in January, I said, this is crazy. Because we were up almost 10% for the month. I said, this is crazy. And we got to hedge and hedge and hedge. And we did. We hedged and hedged and hedged. We had this massive drop, and we cashed in our hedges. Because we said, well, that's too much of a drop now. But you got to be, at all times, you've got to be realistic about the range you're in and realistic about your expectations of what's going to happen. Things are usually not as bad as people think, and they're usually not as good as people think. But you've got to be the one that's a rational one that says, hey, you know what? This is the right price. 27, 28, this is the range the market should be in. This is too high, this is too high, this is too low. This is right. In here is right. And we do that based on looking at the actual companies. And so at some point this year, we looked at I think the top 30 S&P 500 companies, because they make up like 50% of the value of the S&P anyway, and obviously, and the NASDAQ companies, and we looked at the Dow, and the Dow, we looked at all 30 of the Dow. And we say, are they all priced correctly? If they're not, you have to say, well, who's not priced correctly, and what would be the change? But that's all you got to do if you want to know what the Dow should be. You just look at each company in the Dow, give it a valuation, and say, okay, so add them all up, there's your Dow. It's not hard. So it's a mathematical fact. It's not a fantasy, but people treat it like it's some kind of random number. It's not a random number. It's a real number. It's a number of saying this is what Exxon's worth, this is what Apple's worth, this is what AT&T is worth. And I used to M&A consult. So believe me, there's a number. Okay, every company's got a number that they're worth. That number is what somebody with actual money is willing to pay. If I have $300 billion, am I going to give Exxon $300 billion for what they've got? No. Why? Because I don't think oil is going to be at 100. I think that I think Exxon's problem is they price their assets at God knows what. I don't even know what they price their assets at, because I haven't done this in a long time. But so Exxon, for example, has a $360 billion valuation. I certainly wouldn't pay that. I don't know if it's going to say in their profile. Exxon board, blah, blah, blah. Okay, 21 billion barrels. There you go. So they have 21 billion barrels of oil. That's 21 billion times $75 a barrel. $1.5 trillion. So Exxon believes they have 1.5 trillion barrels of oil. And so that's at 75. So now, if you think they're going to 100, it's just like APX. We do the same valuation for APX. So first of all, what does it cost them to extract the oil? Their average extraction cost is actually very low. It's about 20 bucks a barrel for them to extract oil. And they sell it for spot prices, which is going to be like 70 bucks, 75 bucks. So they're clearing 50 bucks a barrel. So they got $1 trillion of profit that they are likely to be able to produce. So in a year, how much oil do they actually sell? Then you go boom, and you say, oh wow, they sell $238 billion of oil. It's not all oil, but let's say 200. Let's say 200 billion is oil. It pretty much is, I'm sure. So they sell $200 billion of oil a year. That means they've got a 5-year supply of oil in the ground. Oh no, I'm sorry, that's the profit. No, so they've got, this is gross, so it's not including the profit. They've got what do we say it was, 1.7? So what was the number? Damn it. So 21 times 75. 1.5. Okay, so 1.6. Sorry, it's called 1.6. So they've got an 8-year supply of oil in the ground. And they're going to sell it, and this is what they're going to produce, and this is their revenues, blah, blah, blah. So now, what are the variables? The variables are going to be what's going to happen to oil over the next 8 years. Is it going to be more or less valuable? Now, I think over 8 years, it gets less valuable. I think that more and more electric, less and less use of cars, more efficient cars on the road. Doesn't matter what Trump tries to do to stop it, the rest of the world is going with more efficient cars. Everyone's going electric, and so the U.S. by itself can't outconsume the rest of the world to make up for the loss of consumption. So demand contracts, their oil in the ground becomes less valuable. How much is the replacement cost of the oil? Will the replacement cost be lower? No, it won't. You still got to go out and drill the oil. It's going to cost them the same amount of money to get it out of the ground. They might be able to buy the land cheaper because it loses value. Oil lands lose value. But the reality is it'll cost them the same amount of money to pull it out of the ground as they're spending now. That's not going to change. So they don't save money. Oil gets cheaper. Their cost is the same. They will get less money, less profit per gallon of oil they sell over time. So what is oil doing to, what does Exxon do to prevent that? They're in the gasoline business. So if oil gets cheaper, gasoline is more profitable, but then the gasoline goes down in price, kind of wipes that out. Chemicals, on the other hand, use oil as a base to produce the chemicals. Though their oil is an input cost, so their chemical company does fantastic when oil is cheap. That's why they have a chemical division, because they want something that does well when oil is cheap. But it's probably only responsible, well, here, I'll show you, let's see. If I say 20% at most. So if we go to all products, XOM, here's the profile, and chemicals 8%, not even close. So 8% chemicals, 16% get natural gas, 50% crude. So half of their money is tied up in the price of oil. Oh, I'm surprised gas and power marketing. That's interesting. That's much bigger than I thought it would be. Anyway, so all these are factors you got to look at when you think about how much money would I really pay? Would I give them $300 billion for this company? I'm like, no, because if I have $300 billion, there are better things to buy. You see, if I have $300 billion, I'm not forced to buy an oil company. That's a different question. If you have $300 billion, you have to buy an oil company. Which one will you buy? I got to look at them and figure out which one I want to buy and which one's the most worth it. Probably still not Exxon, but that's beside the point. But the question is, if I have $300 billion, do I want to make 20 billion a year? And by the way, that's not real, because look at this. On 18 billion earned, they have a $1 billion tax credit. They don't just pay no taxes, they get a refund on the taxes. That's not real. That means this number is not real. That means this positive 1 should be -4, or at least -3. So there's a $4 billion difference. So they really only make $15 billion. So if I give them $300 billion for the company and they make $15 billion, that's at 20 times earnings already. I can do better than that with my $300 billion. I can find something better to buy. So they're not worth it. And that's how you can look. You can look at every single thing on the Dow and figure out, is it worth it? Should it be higher or should it be lower? That's all you have to know. And if you look at all your components, this one should be higher, that one should be higher. Then you think about the weighting, because Exxon has a bigger weighting than GE, because just because it has a higher market, a higher price. The Dow is a very stupid index for that reason anyway. But you look at all the components one by one, and you come up with what's the Dow worth, and what's the S&P worth, and what's the NASDAQ worth. The NASDAQ's worth whatever Apple's worth, basically. Apple completely controls the S&P the NASDAQ 100. It's about 20% of it. So there's really no point. I mean, we just have Apple instead of the NASDAQ. So what are these things worth? Oh, that's a good question. Is Apple dropping as bad as the NASDAQ today? Yeah, look, see, Apple's down 2.5, S&P is down 2.5, and 2.5 is the magic number on the 5% rule. This is where it pauses, because if it doesn't pause at 2.5%, there's a big problem, but pausing at 2.5% does not mean it's over. That means you're in the middle of a downturn. Without a bounce off the 2.5% line, oh, look, there's Apple. If you're not bouncing off the 2.5% line, then something's really wrong. So at the end of the day, if you're just holding this line, it's almost certainly because you're going to be breaking through to the bottom. So Apple, see Apple here, boom, accelerating back, and then it weakened, and now it's back to here. It really looks like it's more consolidating to break down into this range. Okay, so you can see, and that's even worse. If it's only stopping because it's hitting the 200-day moving average of 219, that's the only reason it's really stopping. That's not a good sign. So I'm very concerned right now that this market is going to leg down significantly from where it is now. So I hope our hedges are good enough, and if these moving averages start breaking down on the charts, we are going to be doing another round of hedges. So that's easy enough. We just take the hedges we have. Same thing as when the market's too high, we cash in part of our hedges. The part that's doing very well, we cash it in, and then we add a longer term hedge that's higher, that gives us a higher room to run, and we assume that we'll have to roll the short calls or short whatever that we have. It's the same strategy that we use when we think something's too high. We start doing it when our hedges get too high. So if we're in TZA, for example, so TZA is now flown up, although really, not incredible, but it's a good run. It went from 8 to 10, it's up 25%. So, let's say we have the TZA 8s, and now they're at more than $2, and we only paid 50 cents for the spread. So we cash those in, and then we pick up a longer term, because what if it breaks up, it's going to go high. So we'll pick up a longer term, maybe a 10.14 or 10.15 spread to cover the short $10 calls that we already have. And then if it goes down, then the short $10 calls go worthless, and we've got the longer spread that we will be able to use to cover the rest of our longs. If it doesn't, and plus, of course, we have the cash that we had from the first calls. So that's how we layer into the positions. We add another layer, and then we cash out this layer. As soon as this layer starts going, as soon as the first leg starts going up, we cash it out. That leaves us with a shorter position, short term. If it doesn't back down, we either start lowering that or add more longs or whatever. But it's sort of like a leapfroggy sort of thing. It's like we jump and we hedge, and we jump and we hedge. So we'll see what happens, but this is going to be very interesting because this looks incredibly weak right now, the market. Mike says, what hedge would you put on at this time? I think we just went over one, so let's see. Portfolio 1.5%. I've been over hedge. Well, that's great. Well, we've been very cautious though. But what you want to start doing is just look at your positions and think about how can you reduce your risk. You know, like if you have longs that are, if you feel, especially if you have long positions and you're worried, you might want to look at like selling some short-term calls if you haven't covered already, or if you did cover already, now you got to start thinking about maybe taking off some coverage. What's your next move going to be? You got to think of the next move and how you're going to move ahead and what you're going to do with it. And don't make drastic adjustments, but little nudges. It's like surfing. It's like make a little nudge to get a little bit going in the right direction. Like it's going well now, everything's fine, but what happens tomorrow if it goes up 5%? Or what happens tomorrow if it goes down 5%? Make sure you're ready for both of those situations. You know, that's the best way to look at it. Not your portfolio. I mean, if the market goes up or down 5%, what's going to happen to your portfolio? And then think about like, well, what do I need to change? What do I feel more comfortable with? And Mike said, what hedge this time? I know we just put one up, so let me take a look at the website. Let's see if we can chat and see what we said. Because somebody just asked me that question. Was it DXD? Would you recommend DXD as a hedge? Oh, there you go. So here's DXD. So here's the hedge I recommended just hours ago. What time was this? At 10 o'clock. Well, it's probably different now. And I said, yeah, it's on a $100,000 portfolio. What did I think would be a good play? And that was unfortunately probably a bit lower, probably almost $1 lower. But I said the DXD April 26 calls for $4 and half covering basically with the January 33s. So these have less time. They're going to expire faster. 33 is way up here. We seemed out of reach this morning, but now it's looking like maybe it should be higher. And the 26s. And I said, what's going to happen? You're putting in $5,200 on the spread, 6,000 minus 800. If the Dow drops 10%, DXD goes up 20% to 35. And then what happens? Well, you've got half of them are covered. So you have 8 times 7 is your limit because you're covered with the 33s. And that would give you 5,600 back, plus 7 times 9 because you're not covered on 7. So you get all the money up to 35, which is 9. And wait, 9? Oh yeah, that's right, 26 to 35. And that would be 63. So you end up with 11,900 back on 5,200. You're up $6,700. And then, but then you've got your short calls at only the 33s and it's at 35. So you do a roll of the 33 Januaries to higher Aprils and you widen the spread to make even more money automatically. And that's why I said, so you can widen your spread and get closer to $15,000, which is the magical 2-to-1 payoff, right? So he's taking, in this case, it's 5% of a $100,000 portfolio will pay you back 15% if you get a big downturn. And that's just your first hedge, of course. If it starts going that way, if you break over 32, where you can see that's a dangerous breakout, if we break over 32, then you just add another layer and you have another $15,000 worth of protection. You don't have to hedge your whole portfolio at once for disaster. It's very, very unlikely. I mean, there are supposed to be breaks on the market. It's very unlikely that you're going to get more than a 10% move in a single day. So if you get it, you just wake up tomorrow. If there's something drastic happens and the market moves 10% a day, you just make sure you wake up tomorrow and the first thing you do is add more hedges before they halt it again. And if they halt it again, you add more hedges the next day. And you can only do that if you have cash on the side, which is why we preach it and preach it and preach it here. Don't be over-invested. Always have cash on the side. That's the best hedge for your portfolio, is the ability to get in there and put up a spread like this. By being able, and then the spread has no margin, of course. By being able to take your cash and do that with $5,000 and get you and buy yourself $10,000 of downside protection, and you can do that today and tomorrow and the next day, but only if you have $15,000 sitting around. But if you have $15,000 sitting around, you can get back Now don't forget, in a $100,000 portfolio, if you get 15 and you get back, if you get 15,000, you get back 15 for every 5, then you're going to get back for 15,000, you can get back $45,000. So in 3 times that you have to do this, as it keeps going down 10%, the market, if it corrects 10% 3 times, and each 10% you add another one of these basically, and you get another 10% per, and you get another $15,000, you're going to have $45,000 in cash plus whatever value is left on your longs. And even if your longs drop to $40,000, $30,000, you still have $30,000 in positions plus $45,000 in cash, and that's $75,000. You still maintain 75% of the value of your $100,000 portfolio, and I'm talking in a really bad situation. And the best thing is, though, that you get to then deploy the $45,000, and you can double down on your $30,000 that used to be $100,000, right? So when you do find a bottom, you've got all the cash you need to double down your position and set yourself up for the next move up. But cash is king, and I said that over and over and over and over and over again. Cash, 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 cash. You have to have cash on the side. You have to have buying power on the side, always. Never, never, never think you know what the market's going to do. It can burn you up, it can burn you down. Doesn't matter what you think you're doing, you can get burned. So you make sure you are able to adjust, and that you know what you're going to do to adjust. So when Soma asked me, what do I do with DXD? And he said specifically, so I limited myself to that answer. You know, he can ask me at 9:56 and at 10:15, I can give him, in addition to all this other crap I can give him a detailed answer. So right off the top of my head, I can do that because I think about it all the time. What am I going to do? Just like if you're a good baseball player, what am I going to do if he throws a curve? What am I going to do if he throws a slider? What am I going to do if he throws a fastball? If you don't know what you're going to do if in any of the situations that are likely to present themselves, then you shouldn't be playing the game. As the Yankees learned this weekend. That's pathetic. Oh my God, I was so sad watching that game the other day. I'm not a huge Yankee fan, but boy, did they suck. That was awful. Embarrassing. But anyway, so you've got to be prepared, and you've got to be ready, and you've got to have it. So when you do a hedge, and we haven't gone there yet, it's been ages since we've had a sell-off, but like in the short-term portfolio, these are just our initial hedges. If we think the market's going lower, which frankly, right now, I'm starting to think it might, we're going to add more hedges. And, as I said this morning, if we begin failing these lines, and then we are failing, we are beginning to fail these lines. If we fail these lines on the big chart, if we fall below this 50-day moving average, if we fall below, we're in this zone now. If we're below 28.50, and we are, if we're below the 50-day moving average, I think we are. We're below we're now 25.9, so we're below this 50-day moving average. We're below the 35% line here. We're barely. Wait, what's the NYSE? Where's that freaking thing? NYA. Keep this keyboard. 1275. So we're certainly below on the NYSE. Yeah, we blew this on the NYSE, and we blew that on the Russell. We've blown almost all of our lines. So it's going, if we don't have a recovery tomorrow, and I don't think we will, we're going to have to add more hedges. Tomorrow's going to be a busy day. We're going to be putting on a bunch of more hedges. We're doing the second layer of hedges. We haven't had to do that in years. This is major. This is a big, big problem. And you guys better be ready. So I'd say tomorrow, again, if we're following through on this disaster and everything went wrong, everything went wrong today. The DAX failed, the Eurostoxx failed, our index was failing, everything is collapsing. And the last thing that's going to collapse, which did already, we now hit 12.8 on the NYSE. We now went red again on the NYSE. So we're a long way from any of these guys turning red, but this guy went red, and that's a big deal. When you add a box, it's never good to add a red box, and that's where we are now. And thank God I didn't do the. Had I done the adjustments, everything would be flashing red right now. Like last weekend, I was supposed to do the adjustments. I just didn't because I didn't get around to it. But last weekend, we were going to do the adjustments and move everything up, and I put the lines in. I already talked about where they should be. These would all be flashing red now. We'd be getting warning signs all over the place, and that's what these are, though. These moving averages are warning signs, and we got to take them very seriously. And we're going to have to layer our protection. If tomorrow doesn't turn around, and it can turn around because all they have to do is announce a trade deal with China. They can announce a trade deal with China. They can somehow the Euro Brexit can be fixed. There's lots of little, any one of these little crises can be fixed and give us a little bit of a boost. But if that doesn't happen, and if these things keep deteriorating like I think they are on pace to, we're going to have to add more hedges. As good as this is doing right now, it is not going to be enough if we're going to go down another 10% from here. And we don't really have any long-term positions in the LTP that I'm dying to cash out. So it's more a matter of saying, are we hedged enough? And then start adding more shorts. We just need more positions that are going to pay off in the short market. All right. So that's going to bring it to a close. Are there any other questions? Nope, no other questions. Fantastic, guys. All right, thanks everybody for coming, and we will do it again next week. And I hope tomorrow's not a disaster, but let's all make sure we're here. Oh, I'm leaving. Oh my God, it's always when I'm leaving. I'm flying to. I have to fly back to New York tomorrow. I'll be here most of the day. I'll be here until about 1. So hopefully it's not too much of a disaster in the morning. I hate to be on a plane when the market's collapsing, but that seems to be the case all the time. Anyway, all right, so we'll do it again next week, and hopefully things won't have completely deteriorated, but be careful out there, right? Thanks, guys. Bye.